Selling cash-secured puts on stocks an investor is happy to take ownership of is a great way to generate some extra income. A cash-secured put involves writing an at-the-money or out-of-the-money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or to be assigned and acquire the stock below the current price. It's important that anyone selling puts understands that they may be assigned 100 shares at the strike price. Selling cash-secured puts is a bullish trade but slightly less bullish than outright stock ownership. If the investor was strongly bullish, they would prefer to look at strategies like a long call, a bull call spread, or a poor man's covered call. Investors would sell a put on a stock they think will stay flat, rise slightly, or at worst not drop too much. Cash-secured put sellers set aside enough capital to purchase the shares and are happy to take ownership of the stock if called upon to do so by the put buyer. Naked put sellers, on the other hand, have no intention of taking ownership of the stock and are purely looking to generate premium from option selling strategies. The more bullish the cash-secure put investor is, the closer they should sell the put to the current stock price. This will generate the most amount of premium and also increase the chances of the put being assigned. Selling deep out of the money puts generates the smallest amount of premium and is less likely to see the put assigned. ABBV cash secure put example. On November 8, with ABBV trading around $116.06, traders could sell a June 17, 2022 put option with a strike price of $105. For selling this put, the trader would receive $450 in option premium. In return for receiving this premium, they would have an obligation to buy 100 shares of ABBV for $105. By June next year, if ABBV is trading for $100 or $90 or even $10, they still have to buy 100 shares at $105. But, if ABBV is trading above $105, the put option expired worthless, and they keep the $450 option premium. The net capital at risk is equal to the strike price of 105, less the 4.50 in option premium. So, if assigned, the net cost basis will be 100.50. That's not bad for a stock currently trading at $116.06. That's a 13.41% discount from the price it was trading yesterday. If ABBV stays above $105, the return on capital is $450/$10,050 equals 4.48% in 220 days, which works out to 7.43% annualized. This trade either achieves a 7.43% annualized return, or results in buying a Dividend Aristocrat stock for a 13.41% discount. Company details. ABBV is currently rated a weak buy. The Barkhart technical opinion rating is a 24% buy with the weakest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is in highly overbought territory. Beware of a trend reversal. Of 13 analysts covering ABBV, 9 have a strong buy rating, 1 has a moderate buy rating and 3 rate the stock as a hold. ABBV is a global, research-based biopharmaceutical company. ABBV combines the focus and passion of a leading-edge biotech with the expertise and structure of a long-established pharmaceutical leader. The company's mission is to use its expertise, dedicated people, and unique approach to innovation to develop and market advanced therapies that address some of the world's most complex and serious diseases. ABBV aims to help patients live healthier lives and collaborate on sustainable healthcare solutions. Summary. While this type of strategy requires a lot of capital, it is a great way to generate an income from stocks you want to own. If you end up being assigned, you can sit back and collect the fat 4.5% dividend on offer from ABBV. You can do this on other stocks as well, but remember to start small until you understand a bit more about how this all works. Mitigating risk. With any option trade, it's important to have a plan in place on how you will manage the trade if it moves against you. Some traders like to add a deep out of the money long put to reduce risk. For example, a June 17, 2022 put option with a strike price of 70 could be purchased for around $65. Buying this put would cap losses below 65 and reduce total capital at risk from $10,050 to $3,115.